one now to the economy. If you're hoping to get some capital from the banks, well, be prepared because the central bank has just announced some new fiscal measures. Of course, we now know that commercial lending rates are being revised upwards to Kofi J. Help us with that.
At 29.5%.
Isaac Kofi J is a data analyst, of course, here at JoyNews. Let's listen to the central bank governor, Dr. Ernest Addison, announce that, and we'll get into the figures.
Under the staff-level agreement with the IMF, the Bank of Ghana and the Ministry of Finance have finalized a memorandum of understanding on zero financing to the budget, which will be signed shortly. The passage of the relevant revenue bills by Parliament will therefore conclude the required prior actions to advance Ghana's program to the IMF Executive Board. This will be critical in resetting the economy on the path of recovery, including putting it firmly on a disinflation path and sustained growth. Headline inflation has declined marginally for 2 consecutive months, but continues to remain relatively high compared to the medium-term target of 8 plus or minus 2%. To place the economy firmly on the path of stability and reinforce the pace of disinflation, it is important that the monetary policy stance be tuned further to re-anchor inflation expectations towards the medium-term target. Given these considerations, the MPC decided to increase the monetary policy rate by 150 basis points to 29.5%. Additional measures. The committee also decided to reset the cash reserve ratio on domestic currency deposits for banks from 12% to 14% effective 13 April 2023. In addition, the bank will step up liquidity management operations to address excess liquidity conditions in the market. The committee will continue to monitor developments in the banking sector and deploy other macro-prudential tools to ensure financial stability.
Isaac Kofi is still here with us. Isaac, what's the implication? 29.5% for an average person out there. What would this mean?
So usually the policy rate is the rate at which Bank of Ghana lends to commercial banks. So commercial banks take loans from Bank of Ghana, then we ordinary people, businesses, private persons will go and also take loans from banks. So from a 28% rate that Bank of Ghana was lending to commercial banks, they are now increasing it by 150 basis points from 28% now to 29.5%. That's what we do know currently. So this simply means that commercial banks will see their cost of borrowing from the central bank increasing, thereby also going to increase the rate at which they lend commercially to private persons or individuals in the economy. So this simply means that now that we've seen the policy rate go up almost 30%, it simply means that we're going to find lending rates, commercial lending rate across commercial banks somewhere around either 38 or 40%, because when it was even around at 27.5%, some banks were charging as high as 35%. So imagine now with a rate of almost 30%, banks will now also increase their lending rate or the rate at which they borrow or the interest rate on their borrowing. Yeah.
Can we paint the picture of the nominal terms and what this may mean? Say I go in for a loan of 100,000. What's the implication?
So a loan of 100,000 simply means that you're going to pay more. This is simply because the central bank feel that although inflation is coming down, there's still more liquidity in the system. So they have to find ways and means to make sure they mop up the excess liquidity from the system. The monetary policy rate, the hikes is not going to be the only means. You heard the governor saying that banks will now increase their reserves with the commercial bank from 12% now to 14%. Means banks will be, now have less liquidity to actually loan out to people. But just like you said, if I'm going to lend any money right now, because the policy rate is up, banks will also now adjust their interest rate, the interest rate that they charge on the money, the principal that you are going for. So if you used to pay 400 cedis on a certain loan, mind you that if you pick that same loan currently, you're going to pay close to, let's say, 600 cedis or let's say 500 cedis, because they also need to make sure that they put measures in place to make sure that the extra costs they are getting from, getting loans from the central bank, they're also able to pass it on to normal people.
And we understand that with this latest directive, there's also an implication for the banks themselves.
Exactly. So if you look at the domestic debt exchange itself, the governor said that they've done some bit of analysis, and they've realized that although the banks they still have the kind of liquidity capacity to still do business, they are still monitoring the banks and analyzing, because they feel that the DDEP has actually weakened the liquidity strength of a lot of banks, that they are still monitoring, and they said that they will come in as and when it is necessary to make sure that banks do not collapse, or we do not have what happened in 2017, where we had to do a whole cleanup where we spent close to 25 billion Ghana cedis to do a banking sector cleanup.
Let's talk about other measures that we're taking today. How's that likely to impact the economy?
Well, so the whole thing is geared towards the 3 billion bailout package that we're going to get from the IMF. So one thing that stood out for me is the fact that the central bank has now signed an MOU with the finance ministry for a 0% financing of all budgets. So mind you, 2023, for instance, our budget deficit is around 60 billion. Bank of Ghana has signed an MOU with finance ministry. So what they are telling us is that they're not going to get a penny, free money from the central bank. So everything that we're going to spend in the economy, we have to make sure we generate it. So you heard the governor over there telling parliamentarians of parliament that they should expedite the passage of the 3 bills that we have in parliament. We know we're going to get close to 4 billion Ghana cedis from those 3 bills. That's new levies, or what you call it, taxes. And if they come through, government is going to get an additional 4 billion cedis to make sure that they cut down this over 60 billion deficit that we're talking about. So 0% financing, it means that finance ministry is not going to get any money from the central bank. This is an MOU that was signed because of the 3 billion IMF package. So we were forced to actually sign it. Let me put it that way. It's a condition that we have to meet. We have to make sure that finance ministry does not come in, the Bank of Ghana does not come in to always come and then print money to, finance budget. Because one key element of the 3 billion bailout package we're getting from the IMF, it's not just the money. It's supposed to give us, markets credibility for us to also go to the international fund markets and borrow. And then also help us to strengthen our local currency and reduce inflation from the over 50% to somewhere close to 25%. So if you're going to do that, then you really need to look at monetary and fiscal measures to make sure that you don't have a lot of money, flowing around in the system.
Okay, let's bring in Courage Buti now, an economist, to help us with the discussion. And Courage, what do you see happening to the capital markets?
If you can repeat your question, please.
Yeah, what do you see happening to the markets given this latest monetary policy?
Well, yeah, good afternoon to you and your listeners. Yeah, we've seen over the last, I think, 3 or 4 weeks or so that the government has been on the agenda of compressing T-bill yields. They've done so from about 35% to just about 18 points, I think 3 thereabout percent before the last auction. But because the size on offer last week was much higher than the maturity obligation, I think the market priced it higher this time around, and we saw that trend reverse slightly at this last auction. With this increment in the policy rate and the fact that we've actually reversed the 2% reduction on the cash reserve ratio from 12% now back to the 14% it was, it would further tighten liquidity levels on the domestic market, which means that government agenda to suppress or depress yields on T-bills probably might not see a lot of reduction in the coming auctions, really, because it was the liquidity levels and lack of options on the market that really were pushing banks into such activity where oversubscriptions were leading to reduction in yields. So now that that is reversed, liquidity levels could tighten a bit going forward, which might mean low demand for T-bills, and by extension, yields might not fall that much. I think the other main takeaway from today's meeting, if you like, is that look, I understand the decision. The bank skin system is awash with liquidity, and is the reason they have to tighten up and mop those up so that we sustain this deflation trend that we have seen started over the last 2 months, and then anchor it to a level where we could sustain the decline all the way to the 29 or so percent levels the central bank is looking at by end of the year. But the bigger issue becomes, you've seen the composite index of economic activity for the 6th month running. It has declined, this time to about 7.5 or so percent negative growth for the period of February. And you ask yourself, that in itself means that growth is slowing, and you've seen quarter 3 growth numbers slow down. The governor admitted that we'll have growth for full year 2022 slow down from the even revised 3.5% growth rate that was initially envisaged, really. Now, the question becomes, the governments must raise revenue to ensure fiscal consolidation. And then we have imposed VAT, we've imposed growth and sustainability levy, which would be on the profits of companies, really. And that has been expanded to include all companies. And then we are having the phenomenon of slowing growth. That might mean lower disposable income, lower profits from corporations. And then the question becomes, how do we intend to raise the revenues that we plan to raise? And how does that put the whole fiscal consolidation agenda into perspective, really? I think those are the questions we need to ask. So it is right to sustain the inflation outlook. It will come with short-term, if you like, trade-offs, but it has consequences for growth that need to be looked at holistically. And that is why I feel even at this moment, Parliament should do their best to get those revenue measures going. And we need IMF in town as soon as possible to actually ensure fiscal consolidation gets started. The numbers on the fiscal side did not make good reading, given the revised targets that we've had at mid-year and all of that. You've seen expenditure exceeded a target significantly, even if revenue came very close to the target for the period, really. And so the fiscal discipline is still a question, and we need that supervision from the IMF to ensure that we keep things on target and gain back market credibility. I think those are the most important issues now. And whatever it takes from Parliament, from the Ministry of Finance team negotiating, and every other actor in the chain, whatever it takes for us to secure that deal as soon as possible, we need to be doing.
And Isaac, I guess, of course, Courage is raising an important aspect about T-bills.
Exactly.
And the corresponding effect. Is that far-fetched?
Not at all, because if you actually look at one of the ways government was using to get revenue at the first quarter of the year was T-bills. Mind you, bonds market were completely shut. They weren't getting any money from the bonds market. They were actually now resorting to the T-bill market to make sure that the revenues that were not coming in, usually your first quarter of the year, you don't really get the revenues coming in. So you need to borrow from the market to, supplement your revenue before maybe when the revenues start coming in, you start paying off. But governments use the T-bills to attract people to, it was a way of mopping up money from the system. So if it is 30%, it means if you have the money, you would rather buy T-bills than maybe use to do any other thing or keep that money. So it was a way of mopping up money from the system. And T-bills rates going up as high as 30% meant a lot of people got attracted. They went to buy the bills, and government was really able to mop up. That's why partly one of the reasons why we saw inflation coming down from as high as 54 to now a little over 50% that we're seeing. So reducing the T-bill rates from 30 now to 18%, it means that people are they don't have that kind of motivation to borrow, because they feel that if you've reduced from 30 to 18, it's like you've truncated what I'm going to get by more than half. Exactly. So people will be, they wouldn't want to now lend to government like they would have when the rate was around.
Right.
30%.
Interesting days ahead. And Courage, let's draw the connection to the performance of the CD as well. What do you have to say about that?
Well, yes, the CD it hasn't reflected the fundamentals for the year so far. In fact, given where we ended last year, and at some point last year, we were around 15, 16 cedi to a dollar, and the fact that, yes, it's been volatile, moving between a band of about 11 cedi 70 pesos to about 13 cedi 20 pesos so far this year. But if you look at it in terms of the year-to-date depreciation, about 22 or so percent depreciation compared to what it was sometime last year and the pressures we ended the year with, think the depreciation pressures have been fairly contained. And I dare say that the Bank of Ghana's gold purchase program to shore up the reserves seem to have played a role in that regard. Yes, the gross reserves level would have fallen from the level they ended the year with, but we see between January and February that it grew, and net reserves actually increased from the level we ended the year with. And you are not seeing the kind of depreciation we saw in the last month, or if you like, the last 2 months of the year within this period of first quarter 2023, especially given we expect the seasonality effect to drive it really. So I guess there are some works going on behind the scene. And I tend to side with the governor to a very large extent that exchange rates or the reserve vulnerability, even if it's a concern, is not so much an issue at this point in time because they have tried to manage it even with the low reserves we've seen. For instance, if we started last year with about 9 billion in reserves and now it's just about 5 billion, you expect much more depreciation, but that is not the case. And so whatever good stuff they have been doing, we hope it continues. But the anchor for the cedi going forward will be when the balance of payment support flow in from the extended credit facility, from the our development partners who would have, government is looking to raise the remainder of the financing for 2023 from, if those monies start flowing in, and if we get a deal, that means sentiment on the market kind of stabilize a bit, and we are beginning to see, if you like, a reduction in the outflows and maybe some stability on that front, then volatility of the cedi will be contained a bit going forward. So it is not all bad at this point. 22% is still very significant depreciation, but relative to what we saw towards the end of last year, it is a manageable situation. And the start of the program will bring a bit more relief than we are seeing now.
Okay, then. Thanks, Garage. We'll see you here on the show again.
My pleasure.
Kofi, and just talking about the external debt exchange, we know that the finance minister has returned from China, and that would also be crucial to what we're seeing play out here.
Exactly. So you need to make sure you find good levels with all your creditors before you send a proposal to the board level for approval. Mind you, aside from the debt talks or the debt restructured operation that we seek to do with most of our external creditors, we also need to make sure that we get the revenue, the bills passed, so that we have inflows plus a certain kind of assurance from our creditors that one reason why we are doing this is because, if you look at our budget, we are supposed to do a debt servicing of more than 50 billion Ghana cedis. Right. At this point, we can't pay 50 billion Ghana cedis. That's more or less like a 5 billion US dollars. And how much is even the IMF giving us? It's 3 billion. So if our debt servicing for 2023 alone is about $5 billion, then it means that we have to make sure, we have to do all we can to make sure that we find the fiscal space for the economy to breathe.
Isaac Ofieje with Data Analysis Desk. Thank you for joining us. You're watching The Pulse. We'll be back with some more stories.